When you look at the frenzy that we've seen in retail investors on certain stocks in the U.S., does it infect other parts of the market?
Well, look, I think you are seeing pockets of frothiness come through in other parts of the market. I mean, we saw the Bitcoin frenzy. Bitcoin peaked a month or so ago. So you are definitely seeing pockets of that. But the thing I think that's most fascinating about what you've seen with the GameStop and others that have been happening over the last few days is the unintended consequences of a combination of the transparency that came out after the GFC in terms of on the short side, much more transparency on the short side, because of course in the financial crisis it was very much the same kind of approach that the hedge funds used in order to sometimes put the other side of the trade on with some of the struggling banks. And I think it's kind of interesting that that combination of technology changing, sure, the stimulation checks going through and allowing people then to trade on a retail, all that enabling with that unintended consequence, which has meant that things have happened in markets that no regulators expected. And I think probably at some moment they're going to have to respond to that. So it's really fascinating how these things come together in unexpected ways.
Do you think, Anne, that regulators will start looking at it before it snowballs into something else, or does it have potential to snowball into something else?
Well, if you're a regulator looking at it at the moment, if this were professional investors that were coming together in the same way to go after certain positions, you'd probably be looking and askance at it. Given that it's not that it's a bunch of individuals, it's not clear that the current regulatory framework actually works or applies in that situation. The thing that they could do very, very quickly is remove the transparency on where the big shorts are, because that seems to be the trigger. But then, of course, that takes away from that market transparency, which everybody wanted to put in place after the financial crisis. So I think there will be a lot of regulators around the world scratching their heads to figure out what actually is the right answer here. And I don't think that the right answer is that straightforward or clear. So it might just be something that people have to be more mindful about when you get those very crowded short trades. And I think you will see fewer crowded short trades.
Anne Richards with us. We're going to pause, folks. We've got video from Madrid. This is the center point for the vaccines worldwide. Moments ago, the woman leaving, getting the shot. They're waiting for the next one in Madrid. Madrid will be out of vaccines today in Spain. Catalonia appearing to be next, as Francine mentioned. It is a year up on vaccination in disarray. We continue with Anne Richards of Fidelity. Anne, I want to go back to your electrical engineering at Edinburgh. I'm not going to mince words about it. Math wins here. We've got a gamma vortex. We've got gamma trades. We don't want to bore people with the dynamics. But the slew rates of this new technology, to use a phrase you knew in engineering, the slew rates of the financial system and the derivative markets, how will they fall back on conservative investors like you?
I think we carry on with what we've always tried to figure out, which is how you balance the fundamentals and the underlying dynamics within individual companies, and nonetheless consider how the momentum is playing out. And any professional investor is looking at that combination of and trade-off between value and momentum in any kind of active management of a portfolio. And I think what we've got here, it's very intense, it's very, very focused, but actually it doesn't really change the underlying fundamentals that are going on within the market. And that is much more about how we're seeing, I think, the changing relationship between monetary policy and fiscal policy, and how we see much more shaping of monetary policy now to thinking about the impact on the real economy and effectively passing the buck to the fiscal side of things.
Let me ask you the question. I would have been rude and asked Chairman Powell yesterday. Maybe I'll get an answer out of you. I would have been shown the door by Jay Powell. Anne Richards, can we look at the new viscosity of the global financial system is just too much money from massive global accommodation?
Well, I don't think it is. I mean, I think when you see that we've not yet seen the natural endpoint of the expansion of the central bank balance sheet. We've talked about this many times here before, and you're continuing to see that ability of the central bank balance sheet to ask as that great big sump in the middle. I think what we are, the big mindset shift we're seeing in monetary policy, and I think that came through from the Fed last night, is that debt sustainability is right at the heart of the thinking on monetary policy. And that is why you are, for example, seeing bonds increasingly less defensive in equity market sell-offs. You are seeing a changing dynamic in that sort of defensiveness play. So I think we're seeing a very different approach to monetary policy, which has not been yet made entirely explicit, but is increasingly becoming explicit. What do I mean? I mean that inflation is no longer the be-all and end-all, and managing inflation of central bank policy. I think debt sustainability is debt serviceability is taking over from that. And that really changes some of the dynamics, but we have not yet seen the natural endpoint of where central bank balance sheets can go to. And that experiment we are living through.
So what does that mean in terms of market correction? And when does the market actually latch on that? And therefore, if the narrative changes, do markets change with it?
I think there's a couple of different things which play out in this. The first is it's very hard not to look at those pockets of speculation that we talked about earlier and not feel that the market is due some degree of consolidation correction, because you're seeing that type of speculative activity, it tends to precede some form of correction and consolidation. So I think that is we're probably due that. I think the other side of it, though, if you think about the stimulus that's gone through, the speed of the fiscal response, the things we were hearing from Philip just a moment or two before about how we've contracted this economic cycle and we're now into that recovery phase. You're looking at estimates 7%, 8% GDP growth out of the US this year. That in terms of what it will do to earnings momentum is really pretty significant. So I think you have to balance the fact the froth will get thrown off, will have consolidation, but at the same time, there is still really quite a lot of economic momentum that is driving its way through the rest of 2021.